Welcome to the Big Four Accounting Firms podcast, brought to you by big4accountingfirms.com and the Big Four Accounting Firms YouTube channel. Before we get started, just wanted to remind everybody to support us if you have a chance or if you can. Even $1 helps, and we have a link in the description to a website called Buy Me a Coffee. It's just a way to donate to us and support us. Again, any amount is helpful so that we can keep putting out content. And there's also other ways for you to support us in the show notes to this podcast or on YouTube in the description. In today's podcast, we're going to be talking about Big Four revenues again. But this time we're going to be talking about all three firms that have already released their revenue numbers, and that's Deloitte, PwC, and Ernst & Young. Deloitte had the highest revenues with $47.6 billion made this year. PwC had the second highest with $43 billion, and E&Y had the third highest with $37.2 billion. Now, KPMG hasn't come out with their revenues yet, but they'll be in last place again. Next up, let's go over the growth rates. So PwC had a growth rate of only 1.4%. And we'll discuss about why in a little bit. But E&Y had a growth rate of 4.1%, which is pretty good. And then Deloitte had the highest growth rate of 5.5%. So Deloitte had the highest growth rate even though they already had the most revenue. So even with the most revenue, they're growing the most still. So what about the individual practices? PwC for audit had the highest revenue with $17.6 billion. E&Y had the second highest with $12.8 billion. And then Deloitte came in last for audit with $9.9 billion. As far as consulting goes, I grouped all of the weird consulting groups in Deloitte and E&Y together. And that gave Deloitte total consulting number of $29 billion. PwC and E&Y both had about $14.7 billion in consulting revenue. You can see that Deloitte is almost as much as PwC and E&Y combined. So they've really focused on consulting over the years, and so they're way ahead of them. And as far as tax goes, PwC had the highest tax practice with $10.7 billion of revenue. E&Y had the second highest with $9.8 billion of revenue, and Deloitte had the third highest with $8.7 billion in revenue. So what does all of this tell us? This tells us what I've brought up in the past, that Deloitte could care less about accounting and they're more into consulting. And PwC is really not catching up because of their audit practice. And the audit practice of PwC gives them conflicts of interest all over the place. So they can't get as much consulting work as E&Y and Deloitte can. And you can see that E&Y is about to pass them in consulting work. But PwC has the biggest tax practice. E&Y is catching up though. And I'm sure that's because of the managed services where companies are outsourcing. And I think that's something the Big Four accounting firms should have done during COVID. They should have kept their employees and just offered outsourcing for other companies that laid people off. Looking at these numbers, there's no reason to lay people off. And with that, let's talk about employees. So Deloitte had the most employees this year with 334,800, and they had a 7% growth rate in employees. E&Y had the second highest with 298,965 and a 5.3% growth rate. PwC came in last year with only 284,000 employees, and that was a 2.8% growth rate. We always talk about it on this podcast. The Big Four accounting firms, even to this day, still make money off how many employees they have and how chargeable those employees are. And this is something that I don't think the Big Four accounting firms still understand. The more employees they hire, the better they do. And it looks like PwC got scared here and laid people off and quit their hiring process. And because of that, they fell behind in revenues. But I don't blame them. Fear set in. And Deloitte did the same thing, but it looks like Deloitte hired way more people. And that's what I was saying would happen early on in this COVID process, that because everybody that listens to the podcast was a little bit worried if they were going to still hire. And I said the Big Four accounting firms are still going to hire people because the people coming in are cheap labor. They're excited to lay people off and hire young people because young people make way less money. And with that, I wanted to talk about a metric that they don't talk about. I want to talk about revenue per employee. So Deloitte had $142,174 made per employee, like revenue per employee. PwC had $151,408 per employee, and EY had $124,429. And this makes sense because EY has almost 15,000 more employees than PwC, and they make less money. And what this means is that E&Y charges less. And this is what E&Y is known for in the industry. The way the E&Y wins contracts is they come into their bidding process, the RFP, the request for proposal, and they underbid it. The problem is that they make less money. And they make less money per employee, which probably means your salary is going to be lower. Their partners make less money. Deloitte is in second place. But that makes sense as well because Deloitte has way more employees than everybody else. They just hire tons of people. And I bet what's happening at Deloitte is the partners probably do pretty well, but then the staff people are probably pretty low. So the disparity between partners and staff is probably extremely high. But another thing that's probably happening here is PwC just pays their employees better. And also you have to think about it. If you sit here and look at this reports of the reports of the big four accounting firms, and you're like, why is PwC okay not growing more? Why did they stop growing? And the reason is because all the partners, even though they might have less partners and less employees, they're all making more. You could just stop caring about growth if you make more money per partner. Now you can make more money per partner if you make the firm bigger and you make partners contribute more and earn more revenue, because then senior partners could take more revenue from the junior partners. But also you could just have less employees and just slice up a bigger piece amongst yourself. So that's what PwC is really doing here. It looks like they're falling behind, but not really. The partners are doing pretty well. So that's just something else to consider when you look at this. Another thing to consider is if you're trying to go into consulting, Deloitte is obviously the place to go. If you want to get into tax and you want to be in the best place, PwC is the way to go. And then if you want to get an audit and you want to be in the best place, PwC is the way to go. But if you're an audit, you obviously want to be in EY if you can't get into PwC. And also EY is well known for the tech industry. But overall, these reports are pretty good, considering it was COVID-19 and they still grew. However, what this shows is that many companies aren't struggling as bad as they say they are. But this is still good news because it means that there are going to be plenty of jobs available for everyone that is concerned about getting a job. But that doesn't mean that there still might not be layoffs, but at least there will be less of them for the time being. The Big Four are going to use this time to try and decrease employees' rights, though. That's a given. They've already done that. But they're still going to need highly skilled employees, so at least there will be jobs. And those jobs will pay pretty well too. And obviously at PwC, they're going to be paying a little bit more. And another thing we learned from these financial reports is that the Big Four aren't very good at running their businesses from a financial perspective. And the reason I point this out is because they're accountants. Everybody thinks they are. They all did very well this year, but they should have been more prepared for the pandemic. They scared a lot of people. They did pay cuts. They cut pensions. They laid people off. And no one can predict how bad a pandemic can be. But you have to think of it like a family. You don't cut your family off when times get hard. And many people might say to me, well, you can't look at them like a family. It's a corporation. They don't have a soul. They don't care about you. The problem is all the Big Four make it seem like they really care about their employees and that they're family and that they embrace you and they embrace diversity and they embrace all your quirkiness. But when tough times come, they don't care who they lay off. They lay off everybody. And I don't mean everybody. I'm just saying that they don't care who they lay off. So that's something else to keep in mind. And all of this happens in record years from them. Not record growth rates, but record revenue. They need to learn how to keep more money in the firms to better protect themselves in future crises. They need to quit paying out huge bonuses to partners. I mean, they can still pay out huge bonuses. They just need to save more because they need to think of their employees more and make the situation a little bit better. There's going to be years where there's downtimes, just like there always is. And they need to help people out. And if that means they hire less employees in a certain year, then so be it. or if that means they don't make some weird investments in a weird area, then that's what it means. But they need to be more fiscally responsible, because they did really well this year, and they still cut people's pay and laid people off. And it's one of two things: either they're lying or they just weren't financially prepared. I think they weren't financially prepared, and that's just something they need to do in the future. But overall, this is good because there's going to be jobs. There's going to be the Big Four are going to keep going on. They're going to keep growing. So this is pretty good. This revenue release from all the Big Four accounting firms, and we still have KPMG to go through. So make sure to stay up to date for that. Subscribe to this podcast. Subscribe to our YouTube channel. Support us through the Buy Me a Coffee link in the show notes if you can. If you can't, just support us on YouTube by subscribing, commenting, or liking this video. Thanks for listening.